I only invest in companies that are really making money. Now, why do I say that? I say that because most companies in the stock market don't make any money at all. Why do I say that? Because most companies, 70 to 80% of the stock market listed companies, do not produce free cash flow. And those companies which cannot produce free cash flow, I am not interested in investing in these companies. So what I do is, to figure out whether the company is really making money or not, what I do is I download the annual reports of these companies and I look at the cash flow statement of this company for the past 10 years. If I am looking at 10 different cash flow statements, that gives me a very clear picture as to what the company has been doing, whether it is really making any money or not. So the first thing that I look at in a cash flow statement of the company is the operating cash flow. This is the money that the business is actually generating from doing business, like selling a product or a service. So revenue minus all of the expenses, including taxes, whatever cash the business is generating is the cash flow from operations. Now, if that number itself is negative, that means the company is not making any money. So my first criteria is that number should be positive over a period of 10 years. In each of the 10 years, that number should be positive. Now, in banking and in financial companies, the calculation is a bit different. There you have to look at financing and investing cash flow. But in general, I am saying cash flow from operations should be positive every single year for the past 10 years. If you find a company where this number is negative, even in a single year in the past 10 years, just reject the company. Okay? You don't want to go there. So that is number one, operating cash flow. Then I look at where is the company actually investing this operating cash flow? Where is the money actually going? Number one, the money will go to capital expenditures, which is organic growth. The company will take the money and add more production capacity, right? So that is capital expenditure. They will invest in plant and machinery. Organic growth. Second is inorganic growth. The company will use that money to acquire other companies in the same sector or maybe some related sector. So acquisitions. And the third is financial investments. If there is something left over after making capital expenditure and acquisitions, if there is something left over, that money will be parked in financial investments like stocks, bonds, mutual funds, liquid funds, things like that. So that shows you the flow of cash. The money comes from operations, then it goes to organic growth, which is capital expenditure, then it goes to acquisitions, if there is something left, and then again if something is left, then it will go to financial investments. And then whatever is left over, what can the company do with whatever is left over? The company can give money to shareholders in the form of dividends. The company can use some excess money to buy back shares. So those are the two numbers that I look at. So basically capital expenditure, acquisition and investments, we are talking about investing cash flow here. So the first was operating cash flow, then there is investing cash flow, then there is financing cash flow. Financing cash flow is important to see because this tells us how much money the company has paid out in the form of dividends. We can also check how much money the company has raised by selling equity or debt. We can also see how much interest has been paid out. We can also see how much repayment of borrowings has been done. So that is the financing cash flow. You have to look at all these numbers over a 10-year period and then sum them up, because every year they show how much cash is flowing through the business. So we can sum all these numbers. Now, how do you calculate free cash flow? Well, basically from the cash flow from operations, what you deduct is the capital expenditure. Whatever you are left with, you have to deduct the interest expense and the repayment of borrowings. Then whatever is left over is the free cash flow of the company. This is the money, this is the free cash which is available to the shareholders. This money can be used to acquire other companies. This money can be used to make financial investments. This money can be used to pay dividends. This money can be used to do share buybacks and things like that. So the free cash flow must be there. Companies must produce a positive free cash flow so that the management can do something with this cash. The management can do something positive or something which is value accretive to the business. Now, if a company doesn't produce free cash flow at all, then what is the value for the shareholder? This is the reason why I am looking at the cash flow statement over the past 10 years to figure out whether the company is really making money or not. Thank you so much.